Hello folks, good morning. Welcome to another episode of GSN Invest. One question that we get a lot on our channel, on our WhatsApp, etc. Is that there's a lot of material regarding equities, regarding investing in stocks, but there's relatively lesser material about investing in bonds as such, right? And investing in fixed income securities, right? So we wanted to do a short video to cover the basics of kind of debt funds, the kind of risks you should be aware of while you're investing in any debt or any bond fund as such, and give you a good idea of that, right? And how, depending on your perception of any risk at that particular point of time, how you could adjust your strategies to go overweight or underweight a particular type of risk, right? So we'll kind of divide this session into two parts. Firstly, we'll give you a brief idea of the types of major risks that you deal with when you're dealing with any sort of bond fund. We'll then give you the SEBI classification of various types of bond funds, and we'll end it with a strategy of, depending on the macro at that point of time, how you could go about selecting a particular debt fund, right? So with any major fixed income product that you take, right, any debt fund, any bond, etc., that you buy, there are two major risks that you face, right? The first, I think, is relatively well understood, which is your default risk, right? And default risk is not just kind of a business going bust, but you have a credit risk as well, right? So if a bond that you're investing in kind of derates, the price for that bond will come down as well, right? And that if your bond fund is invested in that sort of a bond, you'll face that price impact on your fund performance as well, right? So credit risk is broadly two types. One is you could have a default risk, where the business is not able to repay either its interest or its principal, but you also have a derating sort of a risk, right? That the credit rating of that instrument goes down, and as a result of that, you face kind of pricing pressure, right? And price pressure on the bonds, and consequently the fund that's invested in the bond, right? So that's one major risk, and one risk that's kind of relatively well understood. The second major risk is your duration risk, right? So to kind of understand duration risk better, we'll need to understand a few concepts. So I'll just kind of go back a bit. The first is your relationship between interest rates and bond prices, right? So there's an inverse relation between interest rates and bond prices, which is effectively whenever interest rates go down, your bond prices will increase, and consequently, whenever interest rates go up, your bond prices will come down, right? And this is kind of very important when you are kind of investing in bond funds, because most people kind of do not understand or do not price in this risk relatively well, right? So the first is the inverse relation between bond prices and interest rates. The second is the intensity of the price movement, right? So suppose you're invested in a bond which is very long dated, right? Suppose you're invested in, say, 50-year bonds or 40-year bonds that the government of India also comes up with. Your sensitivity to an interest rate movement goes up, right? So this is quantified by a number called the modified duration. So we'll do a separate series where we cover Macaulay's duration, modified duration, and these concepts in detail. But for the purpose of this video, it's important for you to understand that modified duration is effectively the sensitivity of your bond or your fund to interest rate movements, right? So for example, if I say the modified duration of a particular bond is 5, that means effectively when bond prices, when interest rates come down 1%, my bond prices will go up 5%, right? Consequently, if interest rates go up 1%, the bond prices will come down 5%, right? So having a higher duration in a bond or in a group of securities is beneficial for me in a falling interest rate cycle, right? So if I'm foreseeing that interest rates will kind of come down very sharply, I want to be at the longest end of the duration curve as possible. Consequently, if I feel that interest rates are going to go up very sharply, I would want to be at the lowest end of the duration curve, right? So that's how broadly you think about the impact of duration and interest rates on bond prices and bond movements as such, right? So with these two concepts broadly understood, right, with duration risk and credit risk broadly understood, let us now dive into the various types of bond funds that are available to you, and kind of understand their classification a bit better, right? So SEBI, to kind of classify by duration, uses Macaulay duration as a proxy to kind of classify these funds. Basically, all of these funds are classified based on their Macaulay duration, right? So there are variety of funds, right, from overnight to low duration, medium duration, low to medium duration, high duration as such. But broadly, we'll classify them into three buckets. One is your low duration, right? So anything less than say 1 year of Macaulay duration, we'll classify them as relatively low duration funds. These funds will have relatively low interest rate sensitivity. So basically, if you have a duration of around 1 or so, if the interest rates go up 1%, you'll have 1% of incremental return. If the interest rates go up 1%, you'll have less 1% return. If the interest rates go down 1%, you'll have 1% of incremental return, right? So that's kind of your low duration fund category. Then you have the medium duration categories, right? So something between say 2 to 4 years in duration would fall from the medium to high kind of duration categories. This is if you have sort of a mixed view of interest rates or do not have a very clear view of which direction interest rates would move. You'd kind of fall in this sort of a category. And the last is the high duration, right? So effectively, if a Macaulay's duration is greater than 7, that is to kind of play cases where you have a very strong view of interest rates coming down very sharply and kind of playing that, right? So three broad categories. Let's for the time being think about it on the duration front. Similarly with credit risk, right? So at the very top end of credit quality, you obviously have Government of India securities, right? So we're talking about bonds from an India perspective. So at the very top end of bonds, you have Government of India bonds. These are effectively backed by the sovereign. So unless the Government of India defaults, which is a rare, kind of very rare sort of phenomena, you'll typically get both your principal and interest back, right? Post that, there are a variety of securities, right? You have your SDLs, etc., which are your state development loans, which are in a way also quasi sovereign, right? So they are kind of issued by states, but they are in fact kind of backed by the RBI, right? So in that sense, they are quasi-sovereign sort of securities. Then you have municipal bonds, etc. Then you have corporate bonds, which are kind of come out, which individual corporates come out with. And then you have the whole curve there, right? So effectively, you have a whole curve right from your government securities at the very end to your weakest credit quality corporate bonds at the lowest end of the spectrum, right? And depending on your view of the credit environment, you can take a position in any one of those, right? So once we've kind of understood this, we can then go on to decide how to allocate between various strategies on duration and credit quality, depending on your view of the macro environment, right? And this is, I think, one area where a lot of you would want to have insight about that given any particular macro environment, how should I go about allocating to bonds, right? So before we go about the strategies and the allocation, let me just give you an alternative, right? So you should know all of the options available to you. So suppose you are a normal person who is kind of doing their day-to-day job, which is not related to finance in any way, right? So you do not have a view on interest rate environments, you do not have a view on the credit environment. You just want some exposure of your portfolio to bonds and fixed income instruments, right? So for folks like that, something like a dynamic bond fund where you effectively give the decision of taking the duration call or the credit quality call to the fixed income fund manager is a relatively good option, right? So there are a lot of good dynamic bond funds in the market, and in case you do not have a very active view on the rate or credit environment, that's a relatively good instrument to go to, right? So that's the first part of it. The second part of it is if you are an active participant in the market, if you keep tracking macros, global macros, Indian macros on a quarter to quarter, year to year basis, depending on how you see interest rate movement happening over the next few months and the credit environment in the country, you can choose between your duration risk that you're willing to take and the credit risk that you're willing to take, right? Or obviously for either of those, you will be rewarded. So suppose you feel we are in a very benign credit environment where broadly underwriting is good, there's no major defaults, etc. likely, it kind of helps to go on the higher end of the credit risk curve because you typically get better yields for a higher sort of credit, right? On the same end, if you believe we are somewhere in an environment where we are right now, where at least on some fronts, right, on the MFI fronts, etc., we are seeing signs of stress, you would want to move slightly better on the quality front, move towards gilts and Government of India sorts of securities, right? So that's the thought process on the credit front. Similarly, on the duration front, right? So we've already been through a lot of rate cuts, etc., that have come in via the RBI. So currently we are in a position where incremental rate cuts from here could be a bit of a challenge, right? Both because if you consider our rates versus kind of global rates, that spread has kind of been compressing consistently. Plus, you have kind of limited room to kind of bring that down further as such, right? So, because our inflation is low, etc., there is still some possibility of a few cuts, but broadly, incremental cuts from here will be tricky, right? Given that in mind, you would perhaps not want to be at the very high end of the duration spectrum, right? So, a year back, or say even uh, 15, 18 months back or so, the market rewarded you for going or to the very high end of the duration spectrum because we are in an environment where the rates were likely to come off very sharply. Now that that has happened, it probably makes sense to slightly move down the duration curve and move more towards lower duration sort of instruments and such, right? So if that is your view on credit and duration, you can take a strategy along those lines where you'll basically be holding say low to mid duration gilts as such, right? Obviously, if your view on macro differs, you can take a position based on that. And if you do not have a concise view on macro as such, you can simply defer to the judgment of a fixed income fund manager and choose a dynamic bond fund, right? So that is a brief overview of the bond market for now. We hope this video added value. If it did, please do share it in your networks and with your friends. We'll see you again next week. Thank you. Thank you for joining.